All right, guys, let's dive into chapter 6. Chapter 6 covers inventories and cost of goods sold. Going back to chapter 1 really quickly, inventory is an asset account that shows up on the balance sheet. Cost of goods sold is an expense account. So basically, to break this down, cost of goods sold is the cost incurred while creating the product that you're using to sell, if that makes sense. So the book kind of breaks it down in two different ways: manufacturing and merchandising. Manufacturing will be covered in accounting principles too, in great detail. But just to go through it really quickly, so the way it's looked at it from a manufacturing side, this is a company like Apple or Dell or HP that are like building computers and building things. They have raw materials, they have direct labor, and they have overhead. These three items will be moved into work in process. Whatever is finished during that period will be considered a finished good, and then they will classify that as inventory. For your merchandising companies are companies like Best Buy, Walmart, big retailers and things like that. They don't sell equipment or anything that is not complete, right? You're not going to go to Walmart and get a rubber for your tire. You can go buy an actual tire, but you can't go get the rubber to make the tire, right? So these merchandising companies, they sell already finished good inventory that is ready to go. So that's the difference between the manufacturing and merchandising. The book goes through this good illustration that you'll need to pay attention to because it is very, very helpful, and it kind of breaks down the way inventory is viewed from a financial statement perspective, right? So what we have is beginning inventory. So this is the inventory that we had at the beginning of the year when we had already started out, or the beginning of the month, whatever period it is. This is the amount that we begin with. During the period, we'll add in our purchases. That's any more inventory that we purchase to sell. And then that will give us our inventory available for sale. I kind of put these in acronyms because I didn't want, or abbreviations, because I didn't want to write that all the way out because it'll go all the way across the board. But from here, from inventory available to sell, you'll have two categories, right? You'll have inventory sold and then inventory not sold. Okay, so for the inventory sold, this is the amount that you'll be able to find in your cost of goods sold, because this is basically saying this is the inventory that we sold throughout this period to make the money that we have. So if you think about it, if we're selling computers, right, and we have, let's say, $10,000 in revenue, to account for the net income, we would have to look at how much those computers that we sold cost originally when we purchased them. So let's say we got a great deal on these computers. We made $10,000 off the computers that we had only purchased for $1,000, right? So we have a $9,000 increase in revenue, but that cost of goods sold would be $1,000, because that's what it took for us to make the $10,000 that we made for that period. So this inventory sold will be able to be traced back to your cost of goods sold. The inventory amount here that's not sold should tie back to your balance sheet on the amount that you still have in inventory. So this amount here, you should be able to tie directly back to your balance sheet, because it's basically saying, okay, at the beginning of the month, we had 1,000 units. We purchased another 1,000 units to sell. So we had 2,000 units available for sale, right? During the period, we sold 500 units. So this is what was sold. And this is in units, not amounts. So the inventory not sold would be 1,500 units. Let's say each of these units is $10. You would come in, multiply that by 10. Your inventory for sold would be 5,000. Inventory for not sold would be 15,000. So that's pretty much a quick breakdown of the intro to inventory.